Welcome, everyone, to another episode of the Adani podcast. We're here with Mark Abramovich, partner here at Adani, uh, the founder of MIRS Group, a real estate lending company. And today we're going to be talking about all things real estate lending. And Mark's going to give us his wisdom on that subject. Hey, Mark, how you doing?
I'm doing great, Craig. It's great to be here. And you said another podcast. I think this is the first one.
This is our first one.
Yeah, so our first podcast. So very excited to be here.
Okay, good. So, Mark, let's start with a little intro on yourself. Tell us about you and how you got started in lending.
Sure. So the story started a little bit earlier. It actually started in 2003 with some trailers in the Pocono Mountains. It's basically very favorite vacation destination for a lot of New Yorkers. And that's where we actually started. We bought a trailer and started renting it out to people. And from there, my journey took me to a real estate education company where actually you, myself, right, my wife, and I learned enough to be dangerous, but not enough to do well. I started lending and got burned to the tune of 129,004 deals. And it's a pretty sizable amount. And one time preparing for a presentation, my older son heard me tell this story. And when I was finished, he said, "Daddy, did you really lose 129,000?" I said, "Yeah." He said, "Does mom know?" So I said, "Yes, she does." And that's, it basically threw me into doing what I do best, which is learning, right? You and I used to work together at the W2 job, and my job there was coming up with new products, which came with a lot of research and figuring out what's going on before you can design something new. So I did the exact same thing when it came to lending. I threw myself into it, learning about how to lend better, how to analyze deals better. And that's actually the big discovery. I mean, look, this isn't the sales presentation. I could just give you all the gold right now. And the most important thing in any deal is the analysis up front, right? The who, what, where, why, how of it. You're looking at a building, it's got to be the numbers on it. And that's what I learned along the way. And that's kind of the intro.
Okay, good. So with lending, why, I the more I study it, is the more I appreciate how powerful this is. I mean, the U.S. is pretty much the only country which allows us to, finance up to sometimes even up to 100% of a deal over 30, sometimes even 40 years at pretty decent interest rates, which makes it a really powerful tool for investors and to build wealth over time. Because if you can take an asset, pretty much finance it, up to 80%, 90%, you're pretty much getting the benefit of inflation, paying down that fixed rate mortgage for you, paying down, after 20, 30 years, once your asset has appreciated and your rents have gone up and your mortgage payment is still fixed. And that really is very powerful for investors to understand that when they can, identify an asset, like you said, run the numbers and secure lending to finance it, that really multiplies their leverage and allows them to build wealth much faster. So give us an overview of the different types of loans we can get and some of the key terms that investors need to be aware of.
Sure. So let's break it down into sources, the kinds of loans, right, and what's involved. So your sources for loans, let's start there. The source of loans are banks, credit unions, right? More traditional sources that everybody's aware of. So you've got your banks, your credit unions. Then there's something called hard money. Right? There's hard money companies. You can call it private money. You can call it, commercial loans. But essentially, under hard money, so banks are interested in the borrower themselves as well, right? So if you've ever gotten a mortgage for your house, you know that they look at 3 years of taxes, your W-2 income, your pay stubs. So they're looking very much at the borrower, the individual that's borrowing. Hard money doesn't care about that as much. They still run a credit check, they still look at the person, but at the same time, they are more interested in the DSCR, the debt service coverage ratio of the property, meaning income coming in and the mortgage payment going out, as well as the expenses. So hard money is looking very much is much more investor friendly, I want to say. And then,
so if I may interrupt you, what's the purpose of them kind of running your credit? If it's more based on the deal, why does hard money look at the investor's credit history?
Because they want to know that the operator knows what they're doing. Just because the deal itself has to make sense, they also want to make sure that the person who's operating, right? What's leverage? Let's back up a little bit, right? You said the United States is one of the places where you can get leverage for investment. Excellent. What is leverage? You're essentially someone, let's just say a bank, is giving you 80% of the money and they are allowing you to operate it, right? If you think about it, you're making money on someone else's money, right? So they want to make sure, or any lender, whether it's a bank, whether it's hard money, whether it's private individuals, they want to make sure that the person who's running the project knows what they're doing with that project, that they're going to actually succeed and get repaid. So because of it, the bank, hard money still wants to look at the credit score, right? A credit score is not the end all be all, but at least it's a snapshot, right? When you ask somebody, what's your credit score? When you hear somebody tell you they have an 800 FICO score versus somebody who has a 500 FICO score, there's a difference there. And you immediately get a sense for this person's savviness and wherewithal and knowledge of what to do with money, right? Whether they pay their debts or not. If you look at somebody's credit score, right, credit report, and you see that they have defaulted on 2 mortgages, do you really want to lend them money? Whether, do you really want to lend them money? That's the question. So hard money does not care so much about your past income, your 3 years of taxes, but they do want to know that you know what you're doing with money. But to them, it's much more important to see that you have the capital to withstand, let's say, the next 6 to 9 months. And then lastly, right, so we talked about, there's the banks and credit unions. And credit unions are a great choice. Small local credit unions will be very investor friendly. They'll lend to LLCs, which is something banks are not fans of. So they'll lend to LLCs. And, you and I are going to have a lot of these podcasts to talk about all the depths of, investing and terminology, because we will have to discuss at some point the difference between borrowing in your personal name versus borrowing into an LLC. So banks are not fans. They want to lend to the person. Credit unions work with investors and lend to LLCs. Hard money prefers LLCs. And then last, an untapped, I think, or predominantly untapped source of capital is private money. Okay. The private individuals surrounding us all day, every day. People with retirement accounts, credit union, retirement accounts, their self-directed IRAs, and considering all of the volatility that we're seeing and what the stock market is doing, mutual fund stock market, suddenly it becomes a question. Well, if you can offer a stable return backed by real estate to private individuals, perhaps that actually becomes very appealing. And where just a short couple of years back, this was only an idea for short-term loans. Well, guess what? If hard money is in the 7 to 8 to even 9% right now on 30-year mortgages, now hopefully all of this will come down in the next couple of years, but investors purchasing properties today can expect easily 8 to 9% interest rates on 30-year mortgages. Well, guess what? That's a pretty high interest rate that a private investor can can invest at as well, even on let's say on a 5 or 10 year loan. So, and that's just regular people, right? Imagine we can offer this to the people around us. We can offer this to our friends and family when they're trying to figure out what to do with their money, and suddenly we can offer them secure investment, right? Backed by real estate, backed by the cash flow, and it's somewhere they can invest their money. So
Okay,
that,
so talk a little bit more about
sure.
that. Because investors, they may be looking at their 401k, they may be looking at their stocks right now, and they're not happy. We're not in the best place right now in terms of returns.
Okay.
And sometimes people, they just don't like the volatility. They're like, you know what,
Yep.
I want something more stable. I want something alternative. How does one go about accessing funds from their retirement account or any other account that they may think is locked up? How can they access that and start investing in a more stable asset, an asset that grows over time, pretty much for the historically, and is a bit more insulated to the ups and downs?
Okay. So before answering that question, this is I think you and I have to start we'll have to start with a disclaimer. Consult with your licensed professionals. This is not tax or legal advice. This is just an education, right? This is information. Take it as you will. It's education for you guys, for all of our viewers, but do consult with your professionals, right? Licensed professionals such as CPAs, attorneys. Okay, how to access your funds, right? So and what I'm describing is the things I've done myself. Okay, it's my own experience as well. So take it as it comes. 401k. If you have a 401k account with your current employer, then they are administering where you're allowed to invest. Now, I am not advocating in any way, shape, or form pulling out your 401k, okay, money before retirement age. You will have to pay taxes. You will have a penalty. That's not what I'm describing. With your 401k, you are allowed to borrow up to $50,000 or up to 50% of the vested value, okay, as a loan. You will have to pay it back, right? So there's going to be some kind of term, there's going to be some kind of interest rate, but you can borrow out of your 401k. So $50,000 can be used as a down payment on a rental property if you would like. $50,000 can be used as a loan to someone else on their property. Now, there's a wonderful term. In addition to leverage, there's also a wonderful term that I love, which is arbitrage. Okay. And arbitrage is the spread between you borrowing at an interest rate and then lending it out at a different interest rate. So, for example, if your 401k, if you can borrow 50,000 at, let's say, 4.5%, 5%, and you can lend that money out. So you borrow at 5, you lend it out at 8% on a rental property. Well, guess what? That's 3% that you get to keep as spread. Okay. Now, you may ask, well, why would I do that? My 401k is earning. Well, the question is, what is your 401k earning? If your 401k is earning, let's say if it's dropping, or in fact, if it's negative, then suddenly earning in your 401k, the interest that you're paying to it, right? Let's say that 5 or 6%, right? So your 401k is growing by 5 or 6%. And then on top of it, you're keeping the 2%, from the spread to the 8%. Okay.
Right. So you're basically taking funds that are growing at a certain rate and allowing them to grow faster, because those funds are already there. You're borrowing out. You're not cashing out. You're borrowing it out.
You're borrowing. It's a very important distinction.
You don't pay taxes on that loan. You borrow it out. Maybe lend it or invest it in a deal, and from the returns of that deal, you pay back your loan, and hopefully you
Correct.
have a spread on top of that
Correct.
to keep as well. So you're
Yep.
increasing the efficiency of your
Correct.
money.
And like we said, right, we started this with, we're seeing a lot of volatility right now. So that becomes a question, right? If we're seeing all this volatility, well, guess what? At least you can, uh, reduce some of it for at least 50,000. Now, that's 401ks with your current employer. Now, additionally, some people have, when I left my job, I had my 401k, which I actually rolled over into a self-directed IRA account. Now, you need to find a custodian, right? There's trust companies that will act as a custodian for your self-directed account. I'll mention a company that I personally use. This is not an advertisement for them. I'm not saying they're best, worst, or anything else. All I'm saying is that this is who I use. Okay, and the company is called Strata Trust Company. At least this is a starting point for all of you, for our listeners to know at least where to look. So I rolled over my 401k when I left the job. I rolled it over into a self-directed IRA account. Now, in my case, it was a Roth IRA account. Talk to your accountant about what's better to do, whether traditional or Roth. In a nutshell, traditional is you're earning pre-tax, right? But then when you start withdrawing, you're going to be paying taxes on the money you withdraw. On the other hand, Roth, you're putting in after-tax money, but then all of the earnings, all of the income is tax-free. And the math that I did, between the age when I left the job and the age I'm planning to retire, I figured I had long enough that I was willing to pay the income tax, right? I was willing to pay the taxes, but to get all of my growth tax-free, to be able to access it later tax-free. So self-directed accounts, right? So if you have an existing account from an old job, you can roll it into a self-directed account and deploy it that way, right? And then, just like the name implies, it's self-directed, right? So you are self-directing where to invest it. Your custodian, handles the paperwork and to make sure that it's all within the tax code so that there's no unpleasant surprises later. But essentially, it's tax-free. So that's another method of accessing your retirement funds.
Okay, so walk us through a little bit. Let's say we have some new investors here. They want to finance a property. They've identified a property. What's the high level steps they can go through to, they know they want to invest in real estate. They need to get a loan. They don't have all the cash.
Yep.
Give us an overview of the process from start to finish.
Sure. So on a 1 to 4 family, now predominantly I work with hard money, okay, commercial loans. That's the primary capital source. For 1 to 4, so let's talk about property really quickly. Let's just look at the property types we have and real estate investing, and then we'll get to what they can expect. So in the investment, in the real estate investment world, right, there's kind of, with properties, there's one of two ways of investing. You're either, you can say fixing and flipping, or you're buying and holding, right? You're either buying a property as a short-term value add, you're going to buy it, you're going to do something to it, and you're going to sell it, or you're going to buy it and then hold it for the long term, right? That's really, not to say that there's not something else, but kind of the bulk of the investment world, that's what you're doing, right? Those are the two paths: buy it and sell it, or buy it and hold it. So
fix and flip, or buy
and hold. Yeah, that's kind of, in a nutshell, those are your two paths. Now, so with and since we're discussing buy and hold, with buy and hold, again, it also divides into properties that are 1 to 4 family or 5 and up. Okay, now there's, so when the term commercial gets used a lot, commercial properties, and I always have to ask, commercial as in 5 or more units, or commercial as in it's a warehouse or office space? Okay. So 5+, even residential properties with 5 or more units, apartments, doors, call it whatever you want, they are treated as commercial. The way they're evaluated is based on their income instead of just on what's the property worth. So where does this come from? It comes from the Fannie Mae, residential consumer mortgage world. So properties that are 1 to 4 family are treated as just residential properties, and their value is established by the appraisal. Okay, so an appraiser comes in, and well, values are always established by an appraiser, but what I mean is their sales comps, right? So you've got properties in the area selling for this much money, and so these this building is worth similar to the one down the street, right? If down the street a 4-family house sold for 300,000, as long as the conditions are the same, then the house, the building that you're buying, if it's 4 families, should be worth about 300,000. If it's 5 units or more, it's not so much about what similar properties are selling for, but now it's a question of rent. Okay, so the appraiser will look at the sales comps, but the appraiser will predominantly, right, that the biggest weight of this will be on what is the income and expenses of the property. So you've got 5 apartments renting for $1,000 each. That's a $5,000 rent roll. Great. This building, based on some capitalization rate, is worth X amount of dollars. If down the street we have a similar 5 apartment building, and all of the rents are $2,000 per apartment, right? So now the income for that building is $10,000. Now that building is worth more based on the rents. Okay, so if 2 4-unit buildings side by side are being evaluated based on their sales prices, 2 5-unit buildings side by side are being evaluated on their rental income. It's a huge distinction.
Okay, so does that mean I can increase the value of my building? Let's say if it's more than 4 units, I could potentially increase the value of my building by upping my rents. Is that
absolutely? And there's a term for it. It's called stabilization, right? And value add. That's a huge opportunity, right? If a previous landlord, did not keep up with rental increases on his building, right? Let's say he had a 10-unit building. He didn't keep up on the rental increase. And over the last 10 years, he never increased rents. That is a huge opportunity to now purchase, because the building is going to be worth a lot less based on the current rent roll that is being collected. And you buy the building, you increase rents, right? Some of the tenants now, just a warning to all of our listeners, right? Or viewers, listeners, if you increase rents, especially, it's a pretty big jump from 10 years ago to now. If you increase rents, there will be something called vacancy, right? Some of the tenants are just not going to stand for it. They're going to be shocked. Oh my God, I'm used to paying this much. You're increasing my rent. And some will move out. So there will be some volatility in terms of vacant apartments. With vacancy comes turnover, right? Somebody lived in an apartment for 10 years. Now you have to paint it, possibly change some of the appliances. But when you're done stabilizing the building, the value jumps up, right? The value used to be based on, let's say, 1 rent, and now it's based on a much higher rent, and thereby has a much higher value. So yes, Craig, that is exactly what a lot of
us. Okay, so that's probably an advanced strategy we can talk about on a later podcast. But let's say we have a beginning investor. Maybe they're looking at a duplex,
a 1 to 4 family, just to make it easy.
What's kind of their first steps to get to pre-qualify or purchase that property?
All right. The first step for anyone, whether it's a beginning investor or an experienced investor, the first step is to analyze the property, okay? To do an analysis and underwriting. Now, let's separate those 2 terms, analysis and underwriting. Analysis is the story. Think of it that way. It's the story of the building, and then underwriting is the actual math. Okay.
So how
And
how does the
well,
story play into
the
I
math.
know how does the
Oh,
story play into actually the financing of it? Why does the lender care about the story of it?
why does the lender care? All right. So let's so first analysis, right? The investor themselves, they have to know the story of the building. Does the roof need to be replaced? Is the entire building in disrepair, or is the building what's known as turnkey, ready to go, and they just need to buy it and rent it out? That's a big part of the story, right? Because that will determine what needs to happen. Does the building need to be purchased, fixed up, and then rented out? Or is the building already ready to go, right? No work necessary. That is what the investor needs to know as the story. And then that feeds into their mathematical underwriting of this building. Now, I'm going to throw something in. I know I threw a lot right now at someone, especially, as you said, a beginner. Let me simplify it. You need to know the numbers, okay? You need to know the numbers on the investment, and we'll on future calls we'll talk about how to how to get into the nitty gritty of the numbers. For now, let me just say that people can visit my website at mirsgroupllc.com and download a underwriter there, an underwriter spreadsheet. It's an Excel spreadsheet that I personally developed and use for analyzing and underwriting my own deals. Okay, this is not
So
something that's it's not like I use some secret sauce. Okay,
okay, so let's say they fill out the form and they see that they have okay, well, I'm getting at
so
the end
for
of the month $200 extra or three
okay,
hundred bucks extra. How do I know that I should even pursue this deal or not?
all right. There's going to be a percent. So so there's a couple of ways. So all right. I'm still trying to answer your question from before of what they can expect. So hang on. So let's answer that question first, then we'll get to what
Okay.
they should see on the spreadsheet. Okay. So first things first, download the spreadsheet and start getting familiar with filling in information into it so that you can analyze a deal. All right. So the first thing to do is make sure that it's a good deal. From there, typically, an investor can expect 75 to 80% of the financing to come from a hard money company or a bank, credit union. It doesn't matter. So now you find out what what the current financing terms are. You plug it into the spreadsheet, and you determine if the deal is a cash flow positive deal or if the deal is a cash flow negative deal, whatever it is, right? You need to know what the numbers are. Is the property, after all expenses every month, still putting something in your pocket, or is it costing you something every month? And that is the first step to know whether it's a cash flow positive or negative deal. From there, if the deal is a cash flow positive deal, and we'll discuss, how much, how positive does it have to be, but at least once you know that the deal is a cash flow positive deal and it's something that you want to purchase, and there are reasons to buy a cash flow negative deal as well. We'll cover that in future calls. And by the way, this is not me pre-planting ideas that people have to come on these calls, but there's just so much information that if we were to go through all of this, guys, you'd be listening to us for the next couple of months straight. So you analyze the deal, right? And you can expect that a lender will provide 75 to 80% of the purchase price. That means the remaining 25 to 30, 20 to 25% is coming from you, right? That's the down payment. In addition to the down payment, you're going to have some closing costs, right? Whether it's the cost of an appraisal, title costs, whatever taxes are due, property taxes. Um, you know, so
You put in the numbers for the
yep,
expenses.
correct. You feed it all, but that's what you. So just roughly account that another 5% will have to come from you for the extra fees. So pretty much you're coming to, if you're buying a property, a 1 to 4 family property, expect that you're bringing 25 to 30% out of pocket. Okay, that's what you're going to have to come with. Now, what will the lender expect? Well, if you submit for, you submit the information to get a loan in the means, right? So you're working with the seller to negotiate the price and buy the property for them. At the same time, you're working with a lender to get a loan to finance this deal. On future calls, we'll come into the nitty-gritty of how else you can close, whether you use private capital to buy it and then get a loan. We'll get into that, but just in
So once they just, I want to make sure our
there's a
listeners
lot.
understand. Once they fill out this form and they get the numbers,
Yep.
is there a certain, like, I know you said sometimes lenders will fund negative cash flow deals, but what should an investor be looking for in terms of return, or how do they know that this is a good deal? And what does the lender look at? Are there certain expenses they look at more than others? Are they, put it in repairs? Are they like, how are they looking at these numbers? And I know you mentioned debt coverage service ratio in the beginning. So maybe we can go into that and how that plays into the numbers.
All right. So what a lender typically looks for is and it depends on it's all dependent on the specific capital source, right? The specific lender, whether it's a local bank like Webster Bank for us, or whether it's a large hard money company. They're looking at the debt service coverage ratio, and they're looking at a positive one usually, meaning 1.1. What does that mean? It means that that your cash flow per month is 1.1 times of your mortgage payment. In simple terms, if your mortgage payment is $1,000, they want your income to be $1,100. There's your 1.1 ratio. Okay. Some lenders are more conservative. Some credit unions, they want a 1.2 or 1.25 DSCR. Okay. Expense. So, and this is, and they're usually calculating in some expense ratio as well. Again, you don't need to do this manually, right? That's why spreadsheets exist. That's why you can download the one that I use, and it will spit out the DSCR there for you. Okay. And again, we can talk about the expenses you can expect with a rental property. Just let's first get through the loan process, I guess, of financing.
Yeah. Let's focus on the loan process.
Sure. So loan process is, you fill out, you go to a lender and you say, hey, I've got this property, right? The numbers make sense. Here's what the rent is, property taxes, insurance, my, here's what I'm buying it for. And the lender says, okay, you know what? The numbers are good. We're going to finance it. We're going to provide 80%. The next step is to get an appraisal. Okay, so this is an independent third-party appraisal. A lot of borrowers, they yell sometimes at their lenders, and they're like, "Oh, their appraisal, they blew up my deal with their appraisal." As a lender, I can tell you, I don't get paid until I close a deal. It is not in my interest to blow up a deal with a bad appraisal. But what the appraisal does is it's an independent third-party set of eyes double checking the numbers. Okay. I don't know the borrower. I don't necessarily know the area that they're buying in, that they're investing in. So I need somebody to be a third party, right? An independent person to verify the numbers for me, to tell me, you know what, Mark, guess what? This investor, they're right. This property really is worth, $300,000. At the same time, sometimes investors miss something. And it actually is a good double check for the investor as well. If the investor is, looking to pay $300,000, and the appraiser comes in and says, you know what, actually, this property is not worth $300,000. There's deferred maintenance. The roof needs repairs. Actually, properties in the area are not selling for $300,000. They're only selling for $250,000. Well, guess what? It's a good double check for the investor as well. So what we do is we order a third-party appraisal. Right now, usually we place the order, the payment goes to the individual. It's not like it's a profit center for us, and it's not. We're not collecting payment. It doesn't go to us. It's, we simply place the order with the appraiser, and they send the payment, or usually we work through what's known as an AMC, an appraisal management company, right? The management company reaches out to the local appraiser, depending on where the property is. And the appraiser says, I'm going to charge however much, $500 to $800 for an appraisal. And the appraisal management company says, okay. And the payment link goes out to the borrower. While the appraisal is being done, the borrower is submitting the rest of the documents necessary for underwriting. And depending on whether it's a credit union or bank, or whether it's hard money or whoever the source is, the list of documents will change, right? For example, a hard money company that lends to an LLC will want to see the operating agreement, the EIN letter, and articles of organization for the LLC. And they're going to be.
Is there anything specifically in there that they're looking for, or are they just looking to see that this is a company that's set up, legally set up?
Correct. So the articles of organization is what they're looking at to make sure that it's legally set up in that state. The EIN letter, they're checking to make sure, to get the tax ID number, right? To make sure that there's an actual tax number for, to pay the tax man. We're not going to get on the subject of taxes and IRS and our opinions on it, right? But at the same time, it is what it is with the system set up. The operating agreement actually is where you have the connection between the people and the LLC. Who's running the company, right? Who's managing the company? Who are the members of the company? What are the what happens if somebody passes away? That's all spelled out in the operating agreement. And so the lender is looking for that information, and obviously it needs to be executed, right? Everybody has to actually sign. A lot of times, we rush to create an operating agreement, right? Or we'll take a template and update it and modify it, but not actually sign off, right? That step kind of gets skipped. So that's, so we're collecting those docs. A credit union or a bank will actually want 3 years of tax returns. They want to see what's happening in your income, because they're not just looking at so credit unions and banks don't just look at the property, they're also looking at what's going on with the borrower. Because if the property itself isn't performing, they're looking to the borrower individually to to carry,
if they were
to cover the loss. Right. To cover any deficiency. And so they're looking at, well, what's going on with your income, right? Is your income increasing over the last 3 years? Is your income decreasing over the last 3 years? What are your expenses, right? What are your liabilities and assets? So they're not only looking at the DSCR of the property, they're looking at what's known as global DSCR of your total net worth and what's going on with financial
world, right? Basically
health, your economic health.
Yeah.
So that's all the different docs being collected. Now, when all of the information is available, right? And there are also in the meantime, the whoever is the title company or the title attorney is also running title work on the property to make sure that title is clear, nobody is owed anything, right? And this property can be sold. When all of it is available, right? When the appraisal comes in with the values, when all of the documents are collected from the investor, all of that paperwork is collected and goes to an underwriter for review. Okay. Underwriters are basically this black hole invisible to everybody, right? The underwriter says, the ultimate third-party authority. But in reality, underwriters are the people who actually go through all of the documentation with a fine-tooth comb, right? They're the people looking at the operating agreement saying, wait a minute, you missed a signature, or it doesn't mention who's the manager. They're the ones looking at the driver's license and saying, wait a minute, your ID is actually expired, right? Not that you expired with it, but IDs are used to verify addresses, right? So if it's an expired ID, well, wait a minute, we need a current one. They're the ones looking through all of the figures on the deal. So this entire file goes to an underwriter and goes through underwriting, right? The nitty-gritty review. After it passes through underwriting, it's either approved or there's some conditions list. Okay. For example, your home insurance you're borrowing 120,000, but your home insurance policy was actually only for 110,000. So you need to increase coverage to at least cover our loan, right? Obviously, with insurance, do you want to? It's up to you and your insurance agent to figure out how much you should cover for, right? Whether it's replacement value of the building, whether it's cost basis. Again, that's a whole nother conversation with, better to be had with an insurance agent. But from a lender's perspective, I at least want enough coverage to cover my loan, right? I don't want the coverage to be less than what the loan amount is. And that's something underwriters check for, right?
Okay.
All that nitty gritty. And when
these days, how long is this whole process taking from start
underwriting? 2 to 3 days. Here's
from a loan, from
beginning
first
to
application to getting approved. Typically, what are you seeing now in terms of approval times?
And that's let me finish the process, and we'll back out and kind of give it a timeline. And then after underwriting approval, it's typically another 2 or 3. Then comes the closing, right? So that's the steps. You apply for a loan. We start processing the loan. The loan, there's the underwriting for the loan, and then there's the closing, right? 4 steps. How long? The application and kind of that initial step is one or 2 days, right? The deal is submitted. The information is submitted. We review it, provide a quote. The borrower says, yes, I want to proceed with the loan. We start working on it. We order an appraisal. So that process is about a day or 2. Appraisals take 2 to 3 weeks. Okay. That's generally what they take. Now, can an appraiser who's got a little less work these days, get it done faster? Yes. Is it if you're a repeat borrower and you already have kind of an established relationship and the appraiser knows you and everything gets scheduled quickly, can it get done faster? Yes. Don't forget, when you're doing appraisals of rental properties, typically appraisers need to get into the rental units. Now, the time is not only dependent on the appraiser and, let's say, a real estate agent or the property manager showing the apartment, but it's now dependent on the tenant allowing access. What's the timeline for that, right?
We know a lot about that.
I know you deal with it, right? So
we
now,
know a lot about that.
Exactly. So appraisals take 2 to 3 weeks, okay? So now underwriting's pretty quick. It's 2 to 3 business days, right? And the reason why I stress business days, right? Providing all the documents on Friday evening, 6 p.m., and then, Monday morning at 8 o'clock in the morning screaming, wait a minute, why isn't underwriting done? You've had 2 days. It's not really 2 days. It was Saturday and Sunday. And while a lot of people do work on the weekend, right, especially people with their own businesses, and, we can move things around, right? I can work over the weekend and take Monday and Tuesday off. We're still running on a business week, right? So that's why I stress underwriting takes 2 to 3 business days. And then scheduling closing usually is another 2 business days, right? Title reaches out to the sellers, title reaches out to the buyers, and they have to schedule between them. Now, I want to stress, kind of give you guys a tidbit here. You don't have to go to the same office to sign, okay? You don't have to be in the same room. The borrower and the seller don't have to be in the same room with the attorney signing paperwork. You don't need to do that. You can have a mobile notary show up at your house, at your job, at your local restaurant, and you can sit down and sign the paperwork with them wherever it's convenient for you. Obviously, the mobile notary will charge you something anywhere between $100 and $500 for the convenience. And by the way, you don't even have to have a mobile notary come to you. You can walk into most bank branches, most attorney offices, right? There's a notary there, and you can just walk in and have them notarize the paperwork for you, which you then will mail back to the title attorney handling the closing. So your total timeline, right, if we add it up, 3 weeks for the appraisal, a week for the underwriting and closing, and then a day or 2 on top of it for actually getting the submitting the deal. So we're talking about roughly a month. It can be sped up to about 3 weeks, It could drag out to 5 or 6, but kind of a comfortable number is to know that it will take, with hard money. And again, it depends on your capital source, right? Who's the lender? With hard money, you can expect about 4 weeks to close on a property. Now, banks and credit unions have a more involved process. Okay. They take longer because they have committees. The let's say loan approval committee might meet once a month. If you miss the meeting, you have to wait until the next one. So the process there is longer. So banks and credit unions are typically a 45 to 60 day close. Okay, but it's also usually cheaper money. Okay. At the same time, if you're using private capital, and let's say, you're using your own cash, you're using mom and dad's cash, you're using friends' cash, you might not be doing an appraisal, right? They don't care. They don't know. In which case you can shorten the time to just however long it takes to get clear title. I cannot stress how important enough it is to have clear title, to make sure there's no surprises. There's nobody else that shows up later and says, whoa, 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 you couldn't sell, the seller wasn't, a valid seller. Wait a minute, you got bamboozled, right? It was a con man or con woman, selling my property, but it's actually my property. They shouldn't have done it. That's why you need clear title, right? You want a title attorney running the paperwork, making sure that whoever is selling it is the ones who's supposed to be selling it, and there's no liens.
Okay. All right. Cool. Thanks, Mark, for that overview. It was very extensive, but hopefully now we're all experts at financing,
at least at the timeline,
real estate. Let's jump into some current trends here. Sure. What are we seeing today in terms of lending rates? I know we are in a tight position here with banks failing and some things are happening. Kind of give us a state of the union as to what's going on in the lending world.
All right, in one word, volatility. All right, that's what you're seeing, volatility. It's all over the place, right? Rates are changing almost daily. And in addition to rates, LTVs, right? Leverage amounts are changing very frequently, right? Hey, we're providing, lenders are saying we're providing 80% of the purchase price. Oh, wait, we're providing 70% of the purchase price. Oh, wait, we're providing, it's all over the place, right? We're providing 60%. Oh, wait, things are okay. We're providing 80 again. So,
and why is that? Is it the Fed rate? Is it the monetary policy? What's going on there?
It has to do with the Fed rate. It also has to do with, and again, it's broad again, depending on which capital source it is, right? Some are tied to the Fed rate, some are tied to the 5-year Treasury rate, some are tied to whatever, they're capitalizing it, securitizing and selling it off on Wall Street and whatever Wall Street's paying. Some it's private equity, right? So as an example, let's just deal with private money for a second. Let's say a big fund, right? So you've got a millionaire. Let's just say it's private money for ease of this example. Somebody with $100 million says, you know what? I want to be earning 5% on my $100 million. Okay. And so now they turn around and they tell me, Mark, I have $100 million. Find me all the mortgages you can on 1 to 4 family, properties. I need at least a DSCR of 1.2, and I'm happy to lend at 5%. Okay. Now I turn around and I say, great, I've got this capital source at 5%. I need to make something on top of it on the loan. So guess what? I'm lending it out at 7%. Okay. So there's the conditions that this capital source is provided, right? That they want, all the loans they can have. They want to be, they're willing to do at 80% of the LTV at 5%. And there's some spread that I'm keeping. That's it. And we just keep rolling. Now, if that capital source runs out of money, well, that's it. Now you have to find a different one. And let's say the next private, okay, I'm stressing the private part, individual turns around and they're doing, and they turn around, they say, I want to earn 7%. Well, now I have it at, if I want to keep the same spread, I'm lending it out at 9. Safety, right? In times of volatility, all lenders want investors to have skin in the game, right? To make sure that if the going gets tough, they don't get going, right? To make sure that they're tied to the property. Well, the only way to do that is to have that down payment at the time of purchase. And so that's where you suddenly have the pullback on the LTVs, right? So they want the investor to have more money into the deal so that they are more invested into it. Additionally, it also helps with volatility, right? As the value of the property may fall or the rents may dip or whatever happens, well, guess what? If my loan amount is only 50% of the value of the property, we can withstand a bigger storm. Okay. So that's where the LTV shifts come from. The interest rates, as I said, it's the availability of money, right? If Wall Street is, buying at this interest rate, or the Treasury note is at this interest rate, or the federal funds rate is this rate, depending on what's the source of money, it starts affecting the interest rate that's available to the borrower, right? And look, nobody works for free. So if, let's say, the Fed is lending at whatever 4.5% to the banks, and the banks need to mark it up another percent or two, and then you've got the actual loan officers out there, and you need to cover their salary. So little by little, right, all of these additions mark up the go into what the cost of money is, right?
Right.
So
Okay.
in a word, guys, I just want to say it's volatility. That's what we have to get used to. But then, so on the one hand, we've got volatility. Let's look at what real estate earns people, right? What are the returns they can expect in real estate, to understand where the profit centers are and how to withstand volatility. Okay. So when you look at the spreadsheet, on my spreadsheet, it's right in there. You have a couple of different, so there's really 5 ways that real estate earns us money, makes us money, and pays us. Okay. The 5 ways are, the very simple one is rent. Okay. When rent is paid and all of the expenses come out, what's left is called cash flow. Okay. This is a huge number. And the amount, like Craig mentioned in the beginning of this call, that cash flow can be $100 per door, $200. Well, guess what? Personally, I don't look at the dollar amount. I look at the percentage. What's the percent return? So for my dollars into the property, how much am I earning back as a percentage return? Okay. And that's kind of a personal question, right? A friend of mine and I, we call it the greed factor. How greedy are you? What kind of a cash on cash return do you want to see? In times when, things were going really well and money was really cheap from banks, I wanted to see, if I bought a property for 10%, right, for cash, I wanted to see a 10% return. I knew that with cheap financing, if I put a mortgage on it, my returns were going into double digits easily, right? We were talking about, 13, 14, 16% cash on cash based on the cost of financing. These days, money is so expensive that if you buy a property, typically your cash flow actually drops because of the financing. It's called negative leverage. Okay. So let's say
the interest rates are higher now. So
correct.
You have more.
It's such a high expense, right? Yeah. Correct. Obviously, you're bringing less out of pocket, but you're paying a lot more for, but you're returning. Basically, you're bringing less out of pocket, but you're earning, your interest, your return is even less. Okay. So cash flow, that's one. I can't say quadrant because it's 5 ways of return.
What's the next one?
Right. So there's cash flow. The next thing is what everybody's used to, mortgage pay down. So if you have a mortgage on the property, right, with every single monthly payment, a piece of that mortgage gets paid off. So that's 2, mortgage pay down. Now, it's not, you don't capitalize on it. You don't see it until you either sell the property or refinance it, but it's still money in your pocket every single month. Okay, every single month, a little bit of the principal gets paid down. Okay, of
And
the
that builds
principal.
up your equity that's
Correct.
on your balance sheet.
That's two.
Yeah.
Number three is depreciation. So every single day, the property has wear and tear on it, right? So that wear and tear on the property is called depreciation. Okay. It's the wear and tear, and you're allowed to write off some amount of this wear and tear from your taxes. How much, how to maximize it, minimize it, how to use it, that's a question for you and an accountant. I'm sure that Craig will be bringing on a CPA at some point to have this call and discuss tax strategies. But just know that depreciation is a big thing that's available, the tax savings of the wear and tear. Okay, then number four is appreciation, not depreciation, but appreciation. All right, now what appreciation is the increase in the value of the property. So as the property increases in value, right, over time, you are earning that money. Same as mortgage pay down. You don't feel it, you don't see it until you either sell the property or refinance it, but it is happening over time. And then the fifth is especially important today, and this is an inflation hedge. Okay. Now, how does this appear? Well, let's say there's $1 trillion of floating around down there. Actually, I think today it's more like $5 trillion floating around in the economy, maybe even 30 trillion. Doesn't matter. But for ease of numbers, let's say it's $1 trillion, and when there's $1 trillion in circulation, the property is worth, let's say, $100,000. Well, if you double the $1 trillion to $2 trillion, the property, together with inflation, maintains its value, and now it's worth $200,000. But that's not an increase as appreciation. That's inflation. That's the property of the value keeping pace with inflation, right? There's more dollars in circulation. The value of the property relative to those dollars is the state maintains, right? The property didn't go up in price. It's just worth what it used to be worth relative to the total dollars in circulation. So appreciation, that's the fifth quadrant. Now, appreciation and inflation hedge are two different things, right? And the way you could look at it is this: if there's $1 trillion in circulation, the property's worth 100,000, and then there's 2 trillion in circulation, the property's worth $200,000. Appreciation is when from 1 trillion we went to 2 trillion, but the property didn't go from 100,000 to 200,000, but it actually went to $220,000.
Okay. So both of those show up as
correct
a price increase in the value of the
correct. But one of them is just an inflation hedge. One of is the appreciation. But all five of these things work together, right, to give you a return on your investment. This is what you get by investing in real estate. It's all five of these things helping you. So again,
a lot of investors, I notice, they don't calculate all of these. Maybe they calculate their cash on cash at the end, but they don't incorporate all of these. So they don't really know the true return that they're actually getting. And sometimes they think they may be at a loss, but when you calculate everything, and yes, it may not be cash in your pocket today, but in essence, if you did have to sell the property, you'd probably come out ahead if you did take into account all of these numbers. So Mark, we got to wrap up because I have another appointment shortly at 12. So,
just to throw it in, this is why I stress analysis so much, because a lot of investors, you mentioned a great scenario. They think they're earning less, but they're earning more. The reverse is the horror that I see so many times. It's when investors I talk to tell me how they bought a property, right? And when you get into the nitty gritty of the numbers, you suddenly realize that they're bleeding money every single month. They have to subsidize it out of their pocket, or even if they're not subsidizing it out of their pocket, they're not saving for reserves. They're not saving for repairs. And then when the bill comes, it comes out of their pocket and they're actually negative because they didn't run the numbers correctly. So all five of these. Now, I mentioned in the beginning of the call, and I'll wrap it up quickly. I mentioned in the beginning of the call that you can buy a property with a negative cash flow, because if you know that inflation is double digits, if you know that you're going to be increasing rents over the next 5 years, if you know, right, that you're going to be paying down the mortgage, well, maybe your monthly cash flow is not as important, right? You can withstand a year or two purposely.
You'd
You
have to
set
have
aside
those
money,
cash
right?
liquid reserves to be able to
Correct.
weather the first year or
You
two or
purposely,
whatever.
right. You purposely set aside the money for the next year or two, or let's say you know that for the next 2 years, you're going to be stabilizing the property. You're going to be doing all of the repairs. You're going to be finding new tenants. So for 2 years, you're cash flow negative. But then year number 3, you're massively exploding. And so you need to look at this deal as a long-term 5-year, let's say, or 10-year play. Right? What happens?
Okay. All right, Mark. So just to wrap it up here, what's
Sure.
your number? 3 points that if I'm looking to get a mortgage, I'm looking to finance a property. What can I do to get prepared as an investor to make sure I can get my financing?
First things first, download the underwriter and get familiar with using it. It doesn't have to be mine, but you have to get comfortable with the numbers. You have to know whether a deal is a good deal without anybody else. So number one, get familiar with running the numbers on a deal, okay, to know if it's a deal or not. Number two, you have to know who the lender you're going to be working with is, whether it's a bank, whether it's a credit union, whether it's a hard money lender, whether it's private, because that will determine what you need to have, right? I'm not bankable. Not so bankable these days, mostly because I'm self-employed. So it's a little difficult for banks and credit unions to understand where my money's coming from and where it's going. So I prefer working with hard money for my loans. Okay. But because it's hard money, I know that I need to have an LLC, and I know I need to have bigger reserves in my bank account than I would, let's say, with a credit union or a bank. That's, so number one, analyzing the deal and underwriting it. Number two, have an idea of what kind of capital sources are available to you personally. Number three, start looking for deals.
Okay. All right, Mark, thanks very much for joining us.
Of
Enjoyed
course.
this episode. I'm sure you'll be back as we interview other guests and talk about more topics for real estate. So
Looking forward to
thank
it.
you, everyone, our visitors who joined us and our podcast listeners. And stay tuned for another episode. Thanks, and see you guys soon. Bye.